I'm Ethan Rebuck, and I'm here with Brian Winkler, and we're talking loans and homes. Loans and homes. All right. So today we're going to be touching on down payments.
That's exactly what popped in my head.
Loans and homes. Loans and homes. Loans and homes. Shoot. All right. That's why I said it. I was like, oh, well. Loans and homes. Are we restarting or no?
I don't care. I think we just leave all that.
All right. Yeah. So down payments, grants, and not going broke. All right. We know about the loan options we have.
Yep.
Right. And so we have FHA.
Yep.
And for down payment, what can people expect for that?
Minimum down payment, FHA is 3.5% of the purchase price.
3.5% of the purchase price. Yep. And then we have VA and USDA, and I'm going to group those together because that is a big fat donut. Yep. Right. Yep. 0% down. Obviously, you don't have to. You can attribute money towards a down payment.
Of course.
And we know with VA, you're going to have that fee. What do they call that?
Funding fee.
Yeah.
I think funding fee is technically the name of it.
Do they have that for USDA?
No. Yes. I don't do a lot of USDA. I forget what it is.
I don't either.
I think it's 1%.
Hey, people ask about them, and they always switch it.
Yeah. I think FHA is 1.75.
Yeah.
VA's got two different ones depending on if it's your first time or whether. I think USDA is one.
Right.
That's awful. I should know that.
Yeah. Well, here
we
are.
Thanks.
And then USDA, you have your bubble, right? So for USDA, you have to be in a certain map in terrain for the government to say that land is.
Yeah. FEMA comes up with the maps, and it has
country.
To be rural. Yeah.
Country. Yeah. So
although almost all of Canal Fulton's technically.
All of Louisville's in it too, which explains, they used to call us the farmland back in the day. So.
Yeah.
But then you have VA, right? And we know VA, you have to be a veteran, right? I think that the important part there is on the active duty side, you get it right away. Mm-hmm. On the reserves and National Guard side, you're supposed to serve your first contract. So it's a 6-year. Yeah. Mm-hmm. Yeah. And that gets confusing because they kind of switched it in the past. So there was like a certain time period if you did so many active duty days. Yeah. I'm not sure what's in play there. I know that the full contract is still in play, but if you do go on like a deployment for a certain period of time, you also are able to utilize it.
See, I didn't know that. I didn't know the 6 years.
Yeah.
Okay.
Yeah. So you have to hit a certain contract point.
Cool.
Yeah. And then we have conventional. Right? Did we talk about conventional?
No.
Okay. I was about to say, we talked about FHA. I'm like, we're all over the place, guys.
Yeah, conventional, 3 to 5%.
Yeah.
Depends if you're a first-time home buyer, if you're not a first-time home buyer, how much you make sometimes, but 3 to 5% on the conventional side. And then all of them you can pair with down payment assistance through the state.
Yeah.
So
I think the most common misconception I get that way is people hear conventional and they think they have to put 20% down.
Yes.
I actually heard that the other day. I was at a networking event, and one lady said to me, she's like, "Oh yeah, I got to put down 20%, or should I put down even more?" I'm like, if it were me, I would just put the 3% down, so I have more money in my pocket to invest in different ways.
100%.
But I tell every first time home buyer, I'm like, it depends on your situation, your family, and how that's all working out, because I understand risk, reward,
Yeah, the government's geared the conventional stuff towards what they consider low to moderate income. Mm-hmm. So depending on where your income is, if it's 80% of the area median, whatever it is, you can do 3% down. Your rate's a little better, your PMI is a little bit better. So no, a 20% down is a huge myth.
Right.
You still have to qualify, but you can do as little as 3.
Yeah.
Yeah.
What's going to determine? I know we talked about conventional loans and how it's 3 to 5%, but what is determining how much they have to put down?
Outside of the so you're asking basically it's income.
Yeah,
income
right.
And debt. I mean,
that's income.
Yeah, I mean, if you're making $5,000 a month and you've got really good credit, your debt ratio could be as high as 50%. So what's 50% of $5,000 is $2,500.
Right.
That number is what your current monthly debt, just what's on credit, not your cell phones and utilities, just what's on credit.
Yeah.
And the new house payment can't exceed that $2,500. So if you've got $1,000 worth of debt, subtract that from our $2,500. $1,500 is what your mortgage payment can be.
Yeah.
And that's a house of, I don't know, 175, 160, somewhere in there, depending on what taxes are. So
right.
That's what determines So now, if you qualify for a house, your loan can be as high as 150,
Right.
and you want to buy a $200,000 house. Well, then you got to put down 50 grand. I mean,
Yeah.
so, but primarily it's debt and income is going to tell us what you qualify for, and then assets do.
Yeah.
I mean, if you're willing to throw a bunch of money at a house, then your purchase price may be a lot higher than someone who doesn't have that money, because your loan amount is if you've got 50 grand to throw at a house,
Right.
and I can only get you pre-approved for a loan amount of 150,
Mm-hmm.
then you can go to 200 grand.
Right.
If I got someone who's got 10 grand, well, they're stuck at 160,000 instead of
Yeah.
200. So it's all those things, but the biggest thing would be income and debt.
Yeah. And for a first-time home buyer out there who might be clueless on the whole debt-to-income ratio ordeal, it essentially is a way for that lending institution to calculate the risk that you have and how comfortable they are loaning you that money.
Yep.
And that's why the different loan types will have different percentages that they'll approve you up to depending on kind of what you got going on. Then they take into account all the other things, credit score, and it's a whole combination. Think of it as like sliders. They all have to work together.
Yeah.
And then your debt to income, it's all off of, the money you got coming in, what that monthly changes. So you could have a lot of debt. Like, people look at their student loan debt and they're like, well, that's a lot of debt. Mm-hmm. But realistically, what you pay on a monthly basis is not as high as some other debt. So student loan debt might not be as much of a problem as your car payment.
Sure.
Because car payments are like $700 a month nowadays. I don't know.
Anymore. Yeah.
I don't know what's going on, but hey, you think houses are expensive. These cars, I mean, they're mini houses.
Oh, yeah, absolutely.
So
VA is a weird one. VA will take into consideration the square footage of the house,
wow.
how much you pay in taxes.
Yeah.
Because I've got one right now that's really, really tight. Debt ratio's high.
Yeah.
I think it was 1,550 square feet. If you found a house that was more than 1,550, he didn't qualify
Wow.
at that certain price point. But if it was under 1,550, he's actually looking at a house tonight. It's 1,200 square feet, so we're good. But yeah, it takes into all these stupid things. So VA is really intricate if you're really, really tight on something. Where conventional and FHA, and they're not quite as crazy. But that's our job, is to figure out how all that works.
Yeah. Yeah, and they leave that extra 50% there when it comes to your debt to income, so you can pay for the other things, such as your utilities, your other life, needs that are going to come up, savings, right? Yep. These institutions want to make sure that your house payment isn't starving you or leaving you from buying gas and so forth. So that's why that's so important. And I think that a lot of times people hear it and it goes in one year and out the other.
No.
And they have to understand the impact, the debt that they're bringing along, and then their income, and how those two pieces play a role. Like, such as someone who is a 1099, independent contractor, and maybe you're working at a restaurant right now. Maybe you're 19, 20 years old and you're working at a restaurant. You're not getting taxed.
Yep.
Well, how is that going to affect you whenever 3-4 years down the road you want to buy a house, and maybe one of those years your tax return was bad, and you have some debt?
Yeah, I mean, the government runs this whole show, as we already said.
Yeah.
So if you're not paying them taxes on that income, they're going to let you use it to qualify for a house. So, I mean, if we're self-employed, it gets complicated, but still, income, debt, those are the two big things.
Yeah. Yeah. And then it comes to these down payments, right?
Yep.
We know house prices have skyrocketed. Now, we are lucky to be in Ohio, where I think we still have home prices are still high, but there is still a pretty good line of affordability with what wages are, generally speaking. I mean, I have a lot of young people buying houses.
Yeah.
When it comes to down payments, right, that might be a large chunk of money. Even 3% of a house might be a large chunk of money for that first-time home buyer. So trying to think creatively in the mind of a young person and how they can work some of these different tools. What do you think? What have you seen work out?
I mean, like sources of down payment, like where they get their money.
Yeah.
Again, there's some down payment assistance through the state,
right,
which comes with some strings. Gift money from family,
right,
is got to be family. Again, if you can save it, I mean, that's the best way. I've always been a big proponent of having some skin in the game.
Right. What kind of family for the gifts?
It technically can be any family, close, even close friends.
Okay.
They don't really harp on it too much. I mean, I've people say my cousin's gifting me the money. They fill out the gift letter. Cousin writes on the gift letter that their cousin.
Yeah.
Nobody's asking for proof that that's cousin. I'm not saying commit mortgage fraud or anything. I'm just saying it's pretty easy. So it can be family.
Yeah.
I mean,
and that's what, I mean, the family member out there has to know that it is labeled as a gift.
It's a gift.
Now, in almost all instances, yes, you're going to be paying back that family member, and maybe they do want some interest, or so be it.
Sure.
But that, I think, is a great idea if you do have a parent who, maybe they want to help you out in this next journey of life and set you up. Yep. Not that they are going to like completely aid you. I mean, they're going to get that money back, but they understand that it was far easier to buy a house as a first-time home buyer when they were growing up than it is nowadays because of the home prices, and especially, if you want to be in certain areas. Yep. So, as that parent, if you're supportive, help your child out.
Man, let's go.
Yeah, help them out. Like, give them some money, and they'll pay you back. I mean, don't worry about it. Yeah. So I've seen that happen a few times.
Yeah, we do it all the time.
Yeah.
Gift money we see all the time. But those would be really the three things: your own money. Now you can pull money from 401k if you have a 401k, IRAs, things like stocks, penalties, bonds. You're going to pay for it.
But sometimes it can make more sense because of the investment you're playing.
Sure.
This is what I try to tell people. Like, you have to understand, like, okay, so if you pull out that money from that 401k, how is it affecting the money you're drawing? How much are you paying on that?
Yeah.
And then what is the difference going to be when you look at the stock, or not stock market, but the housing market on average, right?
Yeah, that and what point of your life are you doing this? Are you doing this when you're 58, or are you doing this when you're 22? I mean, if you got 10 grand in a 401k at 22, again, I'm not your financial planner, but all right, I pulled $5 grand out of it when I'm 22. I'm going to be able to replace that pretty quick. I'm 58 years old. Am I going to pull 300 grand from my 401k that has 500 in it? No, because that only leaves me with 2, and I'm retiring in a few years.
Right.
So it depends on when you are, how old you are, your situation. But yeah, 401k, your own money, gift money from family, assistance through the state. Those are the most common.
Yeah. Yeah. Then we also know if you're buying a house, maybe off market from a family member, gift of equity. And that can attack the down payment as well.
Huge.
Yeah.
Love gift equities. Those are
fun.
Yeah.
Those are fun. Yeah. The other point here, like, I know everyone talks about like seller concessions and all that good stuff when it comes to real estate transaction, but that is only going to attack your closing costs.
Correct.
So keep in mind, if you're out there and you're young and you're thinking about buying this house and you're like, well, I just got to put down 3% and that's going to be my down payment. So, if I'm buying a $100,000 house, just, off the top of my head, I'm going to be putting down $3,000. That's all I need. Mm-hmm. That's not true. Your cash to close includes your closing costs and then also your down payment. Mm-hmm. So we know that the seller concessions are the only things that can attack those closing costs. You, as the buyer buying that first house or buying the property for the first time, you're not going to be able to put any more money towards your rate buy down, and all those good things with those seller concessions.
Yeah. So, I mean, what I tell my clients is there's 3 things you need to bring to closing. It's your down payment, closing costs, and you always have to pay your home insurance a year in advance.
Yep.
Now, that is not the only things that you pay at closing.
Right.
But because in Ohio we pay taxes back, where the seller at closing, no matter what, has to give you a tax credit.
Right.
So if you add those 3 things up at the beginning and then look at what you're ultimately bringing at the very end, they're going to be very similar. So I try to keep it as simple as possible. So if you just add those 3 things. Now, a seller points to buy down an interest rate are technically closing costs.
Right.
So if the seller really went crazy and you got a bunch of money from you could use some of that to buy down your rate. You don't see that very often.
Right.
But yeah, the seller could kick in whatever they pay can go towards closing costs and prepaid items. So like home insurance is a prepaid. Anything other than the down payment, pretty much. Yeah. Just, so whatever you're doing, you got to come up with the down payment money.
Yeah. Okay, so prepaids, when it comes to that, can they pay for home insurance like years in advance, technically?
I guess technically, but I don't think an insurance agent will let you do that because I don't know about you, but every year my insurance seems to go up, so they're not going to want you prepaying. They'll jack that up for you next year. Yeah,
send it up. I guess I didn't even think about that. That popped up in my head there.
It's a good question. But,
ask my insurance agent what she says.
I got a sneaking suspicion I know the answer.
Yeah. Oh, so awesome. So yeah, I mean, what does this look like in the real world when it comes to these first-time home buyers and what's going through their mind? I mean, what are like the main questions that they're asking you?
Yeah, hopefully I have no idea what I'm doing. Help me. I'd like that person better than someone who's been on the internet, who's been on TikTok. They've seen things that are just a bunch of BS.
Right.
Really, what I prefer is I don't know what I want. I don't know what I qualify for. I need you to tell me, what do I qualify for? And we kind of start from there. Usually my first question then is, what are you comfortable with? Are you paying rent right now? How much is your rent? Are you comfortable with that? And we kind of just start there.
Yeah.
And then we do the credit thing. We talk through income. We talk about the assets. Where's the down payment coming from? All those things. But yeah, I'd say the people who call me up and say I have no idea what I'm doing, I prefer that.
Right. Yeah. Keep your expectations low. I think when it comes to going into these conversations, like you touch on it. If you're watching TikTok and you're seeing, grants, down payment assistance, all this great stuff. Yeah, it can work. And I think we both have seen buyers walk away from the table with a check, and they're not paying, but they're actually getting a check. Mm-hmm. Now, do I think that that's like the best idea for buyers out there? No, but it could make sense. Yeah. And so I think that if you just keep your expectations low, expect to need to have at least, I would say 7 to 10% on hand, at least in a savings account of that purchase price of that property. And I don't want to say more, but this is speaking,
yeah, I mean, you don't want to. I mean, we do it, and we see people do it all the time.
Yeah.
Close, and they've used every penny that they had in savings. I mean, it happens.
Yeah,
not ideal,
right?
And some people can't help it. They have to move, and they have to get into wherever they're going, and they've got to do it. But yeah, ideally, you don't want to do it. You want a little nest egg sitting there in case AC blows up or something happens. I mean,
absolutely,
because there's something that's going to happen. Hopefully it's cheap.
Right.
But something's going to happen that first year.
And don't rely on these home warranties. Don't rely on these home warranties because I tell you, they'll have you running up a wall. And unless you want to fight it for months and, maybe you'll finally win. But by the time it's said and done, you'll be tearing your hair out.
They're insurance companies. I mean, they're gonna fight you. That's what they doesn't mean don't ever do one, but
I've seen some people win, but it's the stories, are few and far to come by. But it's the same thing. Like if you're trying to get your roof or siding covered, and if you're doing that on your own, fighting those companies, trust me, it's not fun.
No,
it's a pain. So
you had a raccoon issue, didn't you?
Yeah. Well, they weren't getting that, but I fought them for the siding. They did that. Good. It just took a while, but yeah, I mean, realistically, when it comes down to it, you don't, have to have any money. You don't have to, pay 20% down, all these good things. Yeah. It's a land of unknown when it comes to down payments and all the stuff relating around buying a house for the first time. No. And you really just need experts in your corner. You need to be able to ask those questions. And I'll tell you what, if me and Brian don't have those answers, we're going to look into them. We're going to find the right people to answer them so that, you can feel confident in your purchase.
We know a lot of people, insurance agents, inspectors, attorneys. I mean, we know a lot of folks.
We're around it. That's for sure. Right. So that's it.
All right.
Cool.
See you.